And there's another spread we're watching also. If you want to flip a few pages beyond in that report that we were looking at, this is a very informative chart. It's effectively hit what it's saying is zero. Okay, I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart.
Okay.
Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, an explosive move in a handful of 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts, and dropped. Now, silver also, like the miners back then, gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline, and it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down, so the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to, 2022, there was a low there at 1.05%, but, the spread's above there now.
And just a quick note for the audience. Yeah. This is another ratio chart that we're looking at. So anytime the chart goes down, that's when silver's underperforming gold.
It could be going up in price at the same time.
Right.
But it's still underperforming. Now, recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing these silver into these gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus these gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022. 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. Okay? Mm-hmm. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. The only difference is we're at it. Momentum almost always leads price. The level that's important there is about 0.14. You can see the scale on the left. Okay, so if silver spread closes 0.14% above the 40-week average, which is the zero line, it will blow that ceiling. And we hit it about 3 months ago, backed off, and right now we're pressing at it again. Now, you close a week out on the spread chart at the top, about 1.26%. It's going to cause this spread momentum chart to break out. Almost always when you have a momentum breakout, the spread will follow. Or if this were momentum of price, then price would follow. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, within the monetary metals, silver's about to shift into a leadership position. So gold thumbs up, but silver 2 thumbs up, because it's going to beat gold. So if you're focused on monetary metals or miners, my personal emphasis is on silver and silver related, as opposed to gold and gold related. So anyway,
so silver miners over gold miners.
Yes, they're lagged. For instance, right now, if you look at the SIL ETF, the silver miner ETF, it's not above its 2011 price high. SIL, 2011 high. You can see it over there to the left. We're not above it. It's a 90 something. We're trading in the 70s. Okay. GDX, if you hit it, which is the gold miner ETF, that's not it. Global X, that's silver miner still. Okay. GDX, there you go. It's above its 2011 high. So the gold miners are beating the silver miners right now. But what we're arguing is that when the spread breaks out favoring silver, you can bet that the silver miners are going to do a sudden catch up to what GDX has already done, namely blow the hell out of all highs in history. Okay. And SIL isn't even above the 2011 high. Don't be negative because of that. Yes, it's been lagging the miners, but if that silver spread breaks out versus gold, and we also run spreads of SIL versus GDX, it's on the edge of breaking out too. So I think there's a shift underway here.
Yep. And here's SIL versus GDX.
Yeah, if you take go back to 2022, you can see that, right there, there's 3 years worth of action you're seeing. Look at what's going on. It's a slightly declining relationship. It's really not collapsing. Yeah, that trend line is important because if you draw it right, you're right. Yeah, there you go. It goes through 4 highs, high closes, monthly closes on the spread, the green candles you've got there. And we backed off from it. Okay, you close a month out at about 93.6%. GDX expressed as a percent of the price of SIL expressed as a percent of the price of GDX. This spread breaks out of what we would determine to be a 3-year gradually declining base or channel. And I think you would explode up out of that spread relationship, meaning the miners will catch up to the gold miners, silver miners will catch up to the gold miners. And I think they'll do it sharply because this little structure here is very potent, very compressed.
When I look across the landscape of monetary metals, what stands out right now is not the price action you see on a simple chart, but the structural behavior buried beneath it. Markets speak in layers. Most people only listen to the top layer, the spot price, the candle formations, the trend lines. But the deeper message is always inside the relationships, spreads, ratios, momentum against long-term averages. That's where you find the truth long before it becomes obvious on a headline chart. Silver in particular is flashing a message that is unmistakably loud for anyone trained to monitor structural change. For 3 years, silver has lived in the shadow of gold, underperforming in a way that made many investors complacent and miners frustrated. But spreads are telling us that not only is that phase ending, it is in the process of violently reversing. And when silver regains leadership over gold at this kind of pivot point, it has historically been a precursor to major multi-year asset rotations that reward early movers in ways few other situations can. To understand this pivot, start with the silver versus gold spread. On the surface, it's a simple ratio. December silver divided by December gold, expressed as a percentage. But ratios like this reveal relationships that raw prices hide. When the ratio falls near 1%, it means silver is trading at an historically cheap relationship to gold. It is where the market essentially says, I have marked this asset down as far as possible. I am not pushing this imbalance any further. That is where major shifts begin. Back in 2020, during the sudden explosive surge when metals went parabolic for several months, silver doubled while gold rose 40%. The ratio tore upward like it was shot from a cannon. But after that peak, silver began underperforming. The spread staircase declined, creating the impression that silver simply couldn't regain its footing. Gold went into a wide, almost lethargic sideways range for 2 years. And during that time, silver trended downwards inside its own structure. Nothing catastrophic, but just a long period of degradation where silver investors felt like they were always waiting for something to happen. The remarkable part isn't the decline, it's how organized the decline has been. This wasn't chaos or randomness, it has built a clear, multi-year horizontal ceiling at 1.32%. Every time silver tried to outperform gold, it bumped into this overhead resistance and turned down. That structure now stretches back to 2021. When you see a multi-year ceiling like that on a spread chart, you're looking at a pressure zone that will almost certainly break when momentum aligns. And momentum is aligning right now. Look beneath the spread at the momentum structure, specifically the relationship between the spread and the 40-week moving average of that spread. This is the structural indicator that usually leads the price spread by weeks or even months. Momentum isn't the price, it's the rate of change relative to long-term trend. When momentum breaks a ceiling, the price spread almost always follows. The chart that has been forming since mid-2022 is a near-perfect horizontal structure, and the spread is again pressing right at that ceiling, the same level it touched 3 months ago. Only this time, something is different. Momentum is refusing to fall away. It is holding firm at the top boundary, pressing against it with a discipline that only shows up during structural transitions, not during routine rallies. When a spread hits resistance, the usual behavior is a rejection and a pullback. But when a market presses a resistance repeatedly without losing energy, it is building the internal conditions for a breakout. Not a bounce, a breakout. And those are not subtle events. They redirect multi-year trends. If the spread closes a week above 1.32%, the ceiling gives way and silver enters a leadership phase over gold. When silver leads gold, it's rarely a quiet phenomenon. These moments tend to unleash large flows that spill directly into silver equities, particularly the ones that have lagged most painfully. The very miners today sitting well under their 2011 highs. This is where spreads become critically important. Silver can be rising in price and still be underperforming gold on a spread basis, which is exactly what's been happening. People look at a price chart and assume the metal is in a bull phase, but the internal structure says it's only preparing for one. That preparation appears nearly complete.
If you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. Okay, that was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up 8-fold from price low to bull high. Okay, these are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for 2 decades almost. Okay, and then in 2001, with a low at around $260, it surged the second time, and when it peaked in 2011, a longer bull market, but the same dimension, 8-fold gain in price, bear low to bull high. Okay. And then it topped and you had to drop back to $1,050 in 2015. And if you measure that as the bear low that, followed that high, we're only a 4-fold move. Again, that low was 1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. Okay, and then there's a more important chart, the one we're really. MSA looks at momentum and structure, but in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13.
And this is gold divided by the S&P.
Yeah,
so
this is take a front month gold future, divide its price into the S&P, express it as a percent.
Right.
Okay.
So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally, meaning it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. When the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month, you're at 61%. You close a month at 60% or higher, dividing December gold future into S&P. And that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, while it's been doing okay versus the S&P for a decade in real terms, up and down but sideways, it's breaking out.
The next phase of this analysis requires stepping back from the immediate spreads and viewing the entire metals complex as a single evolving organism. Markets don't operate in isolation. Gold, silver, miners, industrial metals, equities, bonds. These aren't separate planets. They are connected through the gravitational pull of capital flows. When one object moves with enough force, everything around it must shift to accommodate that movement. Gold has already begun its rotation. Silver is pressing at the threshold. But the real fireworks occur when the mining equities synchronize with the momentum of the metals themselves. Miners are leveraged expressions of the metals, and when the metal breaks structural ceilings, miners typically move at multiples of that gain. But only after the market confirms that the breakout is real and sustainable. That confirmation is what spreads and momentum provide ahead of time. Consider how spreads behaved before the last major secular moves. In early 2000, before the multi-year gold bull market began, gold versus S&P spreads broke out months before gold's price chart showed anything consequential. Investors looking only at raw gold prices saw nothing but stagnation, but spreads were shouting that capital was quietly transitioning from equities into monetary assets. That stealth accumulation phase lasted years. By the time gold took off, the structural rotation was already a done deal. Today, the same signals are forming, only more pronounced and against a global backdrop far more fragile than the early 2000s. World debt levels are exponentially higher. Sovereign balance sheets are more impaired. Real yields are unstable. Currency volatility is rising. And central banks are diversifying in ways that would have seemed unthinkable 20 years ago. These are macro conditions that favor monetary metals in a way few generations ever experience. Within this environment, silver's leadership transition is essential. Gold is the anchor metal, the first step in any monetary rotation. But silver is the accelerant. When gold transitions from quiet consolidation to decisive outperformance, particularly when it breaks above major long-term equity spreads, the next move is almost always silver entering a leadership stage. That's precisely the pivot the current spreads are signaling. The 1.32% ceiling on the silver versus gold spread is not arbitrary. Markets remember levels that reflect behavioral thresholds. For 3 years, sellers stepped in at that level, rejecting silver outperformance. But the nature of the rejections has shifted. Earlier rejections produced deep declines. Recent rejections barely pulled back at all. When a market repeatedly strikes resistance yet refuses to fall away, it tells you something fundamental beneath the surface has changed. Momentum confirms this. The spread's momentum structure, mapped against the 40-week average, is creating its own horizontal structure, a mirror of the price spread ceiling. 4 months ago, momentum reached the boundary and was rejected. But the rejection didn't collapse the structure. It simply retreated slightly and moved right back to the ceiling. This persistence is a hallmark of pre-breakout conditions. Market behavior shifts from reactive to resilient. Sellers lose their ability to create follow-through. Buyers step in at higher lows. The market begins leaning into the ceiling with increasing pressure. Once momentum breaks that horizontal line, the price spread almost always follows. And when price spreads break multi-year ceilings, the asset they represent enters a structural bull phase relative to its counterpart. In this case, silver relative to gold. That has enormous implications for miners. Silver miners have lagged dramatically, not because the metal lacks value, but because spreads have been capped. The moment the spread pops the ceiling, the pricing models used by institutions shift. Silver becomes favored over gold in allocation models, and miners associated with silver move from discounted laggard to leveraged opportunity. That shift in perception alone is enough to reroute large amounts of capital. SIL's multi-year structure against GDX reflects this. The downtrend is shallow, almost lethargic. Markets that want to collapse don't behave that way. They break hard. This market has simply drifted, waiting for the signal from the metal itself. The 93.6% breakout level is critical. It clears a 3-year descending trend line and confirms a reallocation within the mining sector. When both spreads break at roughly the same time, you get a synchronized shift. Synchrony is rare, but when it appears, it amplifies movement dramatically. Think of silver's behavior during the 2020 explosion. The metal doubled in a matter of months. But miners lagged at first until spreads aligned. When they did, miners catapulted higher. The difference now is that the structural base for this move is significantly larger. Instead of being built over months, it has been built over years. That increases the potential magnitude of the breakout. Markets with multi-year structures do not break out for small moves. They break out for secular moves. Layer in the supply side. Silver is not a metal like copper or iron that responds quickly to higher prices by bringing new production online. More than 70% of silver supply comes from byproduct mining. That means the supply is tied to the production decisions of copper, lead, zinc, and gold miners, not silver miners. Even if silver triples, a copper mine will not expand solely to produce more silver. The economics don't work that way. So silver supply remains constrained even during massive price appreciation. This is why silver rallies much harder than gold during monetary transitions. It has the monetary premium of gold and the supply constraints of an industrial metal. When capital rotates into the metal sector, silver experiences a dual bid, one from monetary buyers, one from industrial demand. Supply cannot keep up with either, let alone both at once. Combine that with a global macro environment where bond markets are becoming unstable, central banks are buying gold aggressively, trust in fiat is eroding, and real yields fluctuate with every policy misstep, and you have the recipe for a once-in-a-generation repositioning of capital. Silver is the early beneficiary of that process. It is the hinge point between monetary panic and asymmetric opportunity. Right now, the market is waiting on a few final triggers, none of which require extreme events. A routine surge in gold that pushes it decisively above the spread breakout level is enough. A modest decline in equities that sends capital-seeking protective diversification is enough. A shift in inflation data that undermines confidence in long-duration bonds is enough. A geopolitical flare-up, a surprise central bank announcement, or a liquidity event in commercial real estate, all of these are sufficient catalysts. The structural groundwork is already finished. Only the ignition event remains. When the spread breaks, silver will accelerate faster than gold, miners will accelerate faster than the metals, and capital will flow into the sector with a velocity that surprises even the longtime followers of the space. The first few weeks will likely feel chaotic. Prices will gap. Volatility will spike. Analysts who spent years calling silver dead money will suddenly proclaim they saw it coming. But the truth is that moves like this don't appear out of nowhere. They form slowly, quietly, invisibly, until the moment the structure gives way. Once that happens, the market stops being a debate and becomes a fact. And facts have gravity that no argument can override.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.